Hi, and welcome back. Let's explore some examples of hedge accounting, focusing on fair value hedges and cash flow hedges. Hedge accounting generally falls into two categories: fair value hedges and cash flow hedges. A fair value hedge protects against changes in the fair value of an item due to a specific risk, while a cash flow hedge protects against variability in future expected cash flows. Fair value hedge. A fair value hedge protects against changes in the fair value of an item due to a specific risk, such as changes in interest rates. For example, consider a company with a fixed rate debt instrument. Changes in interest rates could impact the fair value of the debt. The company could use an interest rate swap to hedge this exposure. Both the issuer and the holder of the fixed rate debt can apply a fair value hedge in this scenario. Another example is a hedge of a firm commitment. Let's say an electric utility has a contractual commitment to purchase fuel at a fixed price. If the utility wants to hedge against changes in the fair value of fuel prices, this would also qualify as a fair value hedge. However, note that hedging the foreign currency risk of a firm commitment could be treated as a cash flow hedge instead, depending on the entity's risk management objectives. Cash flow hedge. A cash flow hedge protects against variability in future cash flows related to a specific risk. The gain or loss on the hedging instrument is deferred and recognized in profit or loss in the same period when the hedged cash flows affect profit or loss. For example, a company with floating rate debt could use an interest rate swap to convert the debt to fixed rate debt, stabilizing future interest payments. This is a classic example of a cash flow hedge. On the other hand, some items cannot qualify as hedged items in a cash flow hedge. For instance, a forecast purchase of an equity instrument that will later be accounted for at fair value through profit or loss cannot be hedged in this way. The reason is that the deferred gain or loss on the hedging instrument wouldn't have a suitable offset in profit or loss. Similarly, a forecast purchase of an equity instrument accounted for at fair value with changes recognized in other comprehensive income is also ineligible for a cash flow hedge. Thanks for joining, and see you next time.